If you have mutual funds in your portfolio, then you need to watch this video. Hi, I'm Paul Durso, advisor here at Insight Folios, and it's amazing what you can find when you do just a little bit of research on mutual fund managers. And I found a study by founder and CEO of Research Affiliated, Robert Arnott, and he did a study of just over 200 mutual funds from 1984 to 1998. Every single one of these mutual fund companies had well over $100 million under management. And he wanted to research how many of these firms, these professional money managers, just meet or exceeded or fell below their benchmark. And you know what he found? That an astounding 4% outperformed their benchmark. That means 96% of professionally paid professional money managers, 96% of them underperformed, failed to beat their benchmark. Another study by the same firm, a little bit different study, instead of looking at just 200 fund companies, they looked at all of them. So they took into consideration every fund company in the world. And they wanted to find out over a period of time how many of these fund companies met their benchmark. They did over a 15-year period. And here, let's look over the 5-year period. 82 to 93% over a 5-year period on the average mutual fund company, they have failed to beat their benchmark. Over a 15-year period, it got a lot worse. 93 to 94% of mutual fund companies in America today, on average, fail to meet their benchmark. If we go a little bit further and go over a 30-year period, over the last 30 years, the S&P has averaged about 10.35%. If you look at the average mutual fund company in America, an equity fund, that has averaged 3.66%. Now I'm going to get a little pessimistic here. The reason why I think there's such a chasm between the two, the average of the S&P is 10.3. You just bought the S&P and you held it. You'd have made 10.3%. If you would have paid a professional money manager to manage your money, you would have made 3.66%. The reason why they're doing so worse is twofold. First is these unbelievable fees they charge, somewhere between 3 and 4% annually on a mutual fund. The second is what I call this growth trap, which I'm going to talk about in a minute. But most people don't go all in on equities. They want to diversify. They want to spread their eggs out, so to speak. So you'd have had some sort of asset allocation, not all into the market. That means over the last 30 years, you would have averaged 1.65%, when the market has averaged 10.3%. So the biggest concern, two top concerns of why mutual fund companies struggle to beat the market or even match the market is first, these unbelievable fat fees they're charging, 3 to 4% annually. Secondly, it's this sickness, it's this belief that they can beat the market, that they can time it just right. They can get in at a low price and sell at a high price. I mean, how many of you, even I, have thought many times, yeah, this is a good deal. I'm gonna buy this stock here or this fund, and I'm gonna sell it at a later date at a much higher price. And if there's one thing that we can learn about Vegas, is the house always wins. The stock market is unpredictable. The stock market is untamable. It's gonna do what it's gonna do. We're along for the ride. The only difference in management style that you can really glean for is understanding this S&P and where the return comes from. And if you look deep into the S&P, and we're gonna go way back to the 1940s, and we're gonna go from 1940s to today, and I wanna look at the actual return of the S&P, and what you're gonna find out is that over 50%, 52.7% of the S&P's entire return, which is north of 10%, comes from dividend income. It does not come from buying low and selling high. It comes from staying the course, buying companies, stocks that pay great income, and you make strategic decisions on when to move and when to stay and what's a good deal because it's paying X% of dividend versus a much lower or higher dividend rate. You're now making decisions based on who's paying you more, not what decisions should I make and when, and is it gonna work out in my interest, my best interest? Because if there's one thing that we've learned from mutual fund professional managers, you can't do it. If the best in the business are failing this bad, why would you and I think we could do any better? One thing I think you should focus on, and what we focus on here at Insight Folios, is building portfolios that pay strong income to our clients and to us, and we hold on to that and we make strategic moves over time. So if you have a professional money manager or mutual fund in your portfolio, you may want to look at the facts of how poorly and how much they charge, because it might change your opinion, and go to a much more simple model where you can just buy stocks that pay income that you can count on moving forward. So if you want to learn more, you can call the number on the screen, go to the website. We'd love to educate you a little further. If not, hope you enjoyed this video and have a great day.